So I think that there's a couple things that we should be watching. On the good side of it, you've got nice inflation, which is good for hard asset. On the bad side, you've got the rising interest rates for mortgage payments and higher costs. But the real issue, depending on your strategy, I think is going to be your exit cap rate.
Let's get going. I've got no announcements today because I want to make sure that we get as much as possible here with Ken. So no announcements today, but welcome back to the Real Estate Syndicator Live, episode 12. Super excited to have my buddy Ken McElroy in town. If you don't know who Ken is, I'll do a quick bio, but I'm sure he's really well known here in this community. But Ken is probably best known for being Robert Kiyosaki's real estate advisor and author of multiple books, including ABCs of Real Estate, ABCs of Buying Rental Properties, ABCs of Property Management, and many, many more. And the soon to be released, the ABCs of Raising Capital, which I'm really excited to take a look at that. Ken and his partner, Ross McAllister, who's a great guy as well, just celebrated their 20th year anniversary of starting MC Companies, where over the past couple of decades, they've bought and sold over 10,000 units. I think right now they're about 8. Ken can confirm a little bit later on, but and about $1 billion in assets under management, and with a fully vertically integrated company with, I think, over 200 or 200 employees. I lost count already. He's the host of the Real Estate Strategies podcast and the very ever popular Ken McElroy YouTube channel. And I'm super proud and really honored to be also part of KenMcElroy.com legal advisor. So Kenny, first of all, thanks so much for taking time. I know you're super, super busy. So thanks so much and welcome to the Real Estate Syndicator community, my friend.
Yeah, I love this stuff, man. This is like, this is the easy stuff. This talks about what I do. I'm not negotiating with lawyers or anything.
Oh, God forbid. Hey,
Like
buddy,
you.
look. Yeah, like me, right? Hey, we've got a ton of great questions that have come in already. And if you've got a question, please drop it in the chat, because this is really meant, as you guys know, and for Kenny's purposes, really an opportunity for the community to ask you questions. But a couple of them came in. So I'll start with maybe a softball, Kenny. Let's get current. The Fed today raised interest rates for the expected 50 basis points. Do you think that'll have any effect on mortgage rates? And if so, any effect on multifamily? Because I think that's something that a lot of people are wondering about. So I'd love to get your hot take on that.
Yeah. So we, of course, so there's a few things. I have a few comments on that. First of all, it should not be a surprise to anyone. They told everyone last year they were going to raise rates 6 times this year. So this is the second time. This rate, the 0.5 point, was already kind of baked in the product. So we're getting loan quotes yesterday, today, the day before. So we're always in the middle of something. So we have 6 development and ground up construction projects, and we have 500 units in escrow, 1 in Dallas and 1 in Arizona. Right now. So we're in the middle of due diligence and all this stuff on some stuff. So it definitely affects us. The other thing that it affects, and I'll get into how, is it affects anybody that's doing a value add. So, which is most of the people, in the last,
everyone on this call,
yeah, in the last few years, probably did a bridge. The reason why you do a bridge is because, for those of you might not know, when you do a permanent loan, then it comes with yield maintenance and big prepayments and all that. And I'm probably saying a lot of things a lot of you know. So what you do is you do a bridge, which is a floater, and then you do the value add, and then you capture the value add equity with a permanent. So anybody that is in any kind of bridge, which includes me, we bought 1,500 units last year or something. All with bridges, because they're all value adds. So like probably a lot of you. So obviously you're going to have the result of those, just speaking specifically about my stuff and people that I know, the payments are going to, if they're going to tick up, and the payments are going to be more, and you're going to get further and further away from, what you originally thought you were going to do. So, I guess if you would have started before the Fed, you'd be looking at almost a 3/4 of a basis point more. And depending on the loan size, it could be a lot. So that's, of course, depending on the loan, the servicer, and all. There's a whole bunch of stuff involved there. But the point is, so you have that issue, call them legacy issues on anything that you have. And then you have anything new. So I got a deal right now that I have a best and final call tomorrow on a deal that we're in the middle of. It's and we're 108.5 million, so 108 million. So I called my partner today. I'm like, holy shit! Like, all of a sudden our equity raise, becomes higher. And lenders, it appears they're lowering their loan to values, hedging their risk right now. So I do think, to your point, we're going to have interest costs higher. So you got your equity, or you got your income minus your expenses, and that's your NOI. And that is what it is. And then you have your debt. So as the debt goes higher, your returns are going to be less for you, your investors, or people you're syndicating with, or whatever. So it's going to have a big impact. I predict, it's going to, in a lot of good ways, it's going to rattle sellers, which is good, because buyers, like the stuff, we're looking at, we probably look at, I don't know. I mean, our acquisitions team looks at a lot of stuff, but by the time it gets to me, we probably look at 4 to 6 deals a week after they've been vetted. So fully underwritten, package ready for me to look at. The debt is kind of the wild card right now. And so we've passed in the last month on a number of deals that we might have bought before because of the rising debt costs, because of the future is kind of unknown with regard to debt, because I get concerned, with the uncertainty of knowing what my cash flow is when the debt can fluctuate. Even if you have that really awesome, value add component, rent growth component, there's, no matter what anyone here says, it's pretty tough to cut expenses dramatically unless you have a really bad operator. But so let's just, so really most of your growth is on the income. So I think that there's a couple things that we should be watching. If on the good side of it, you've got nice inflation, which is good for hard assets. On the bad side, you've got the rising interest rates. It's going to cause more mortgage payments and higher costs. But the real issue, depending on your strategy, I think is going to be, your exit cap rate. So if you have a deal that you have a predetermined exit on, let's say you're using some big money somewhere, and it's maybe you're partnering with a big private equity group or institutional equity group. I can tell you, they're the ones driving the sale decision. So, if you came in at a 3 or a 4, let's say, cap rate, and you even have that value add, it could all be erased with a cap rate that goes up. And so, you can eliminate all that value based on an exit cap rate. So lenders right now are concerned about exit cap rates, and they're hedging their loan to value with lowering that and requiring more equity from the borrowers. And of course, equity costs too. So whatever your price on your equity is, you got to bake that into the whole equation. So yes, to answer your question, that wasn't a short answer, but that's what's everything in my brain right now around interest rates.
That's great. And that's a great, now it's a good thing I'm not cross-examining you, because then you'd be limited to yes or no answers. But a lot of people were also, which goes into what you were just saying, how are you navigating through this, right? So that's one of the concerns a lot of the community members have, is like, you're going under these really uncertain times. You don't know what's going to happen with interest rates. Lenders are starting to, lower LTVs, which is already happening before, which is why everybody started doing bridge loans. I must say everybody, most people, the deals aren't even penciling out with the regular commercial. Everybody's doing bridge loans. What are you doing to mitigate all these things? Are there certain steps that you're taking, or how do you approach that issue of these uncertain times? How do you mitigate all of those things?
Yeah, so I think there's a couple things. One, you got to kind of take a look at what you're going to do with the asset itself. So if it's a long-term hold, which is almost everything we have, so we're not really a seller, then it actually kind of takes out that cap rate risk. And if it's underwritten, okay, you can still buy because you have, you just got to kind of calculate and model out your higher interest rate costs. If it's really thin in the first couple of years, then you probably should be careful. So thin meaning, I call it the break even. So, if you can calculate your break even in occupancy by your total expenses plus your total debt costs. So whatever that number is, divide that into your gross income, and that's your break even. So you should be monitoring your break even, and because as we get this higher growth on the rental side, we're still buying stuff, believe it or not, but it has to really have a lot of meat on the bone. Like we just bought a 455 unit in Austin, and it has $411 on the rent roll unrenovated. So basically that's so you don't have to spend capital to get that. You just got to bring everyone to market. Now it's mid-90s project, severely run poorly, really well located, but great buy. So it's a $50 million value add. So there's enough room in there, with that kind of stuff. If you're going to get $300-400 lift on rent, you got to calculate it out, but you're probably going to be okay. If you're looking at maybe 100, low hundreds, it's probably not worth it, because what hasn't really hit us yet and is going to is the rising energy costs, the rising labor costs, the rising material costs, the rising insurance costs, and of course property taxes are already starting to hit us. So they're coming after landlords for all of those. That's low-hanging fruit, really. So your costs are going to go up on the operations side, I believe, and we're baking that in. But in addition to that, I think that if you have a lot of value add and it's there and it's within the market today, not some pie in the sky projection, then I think you're probably okay to buy. Does that make sense?
Yeah. So do you think the people that are going to be in trouble then are those who had sort of thin deals that had the bridge loans, and so now it's time to go into permanent or refinance, and now you're looking at like 2 or 3 basis points higher?
Yeah, and I've been through a few cycles, so there's a couple things that could happen. One is, I do believe rents are going to go up in majority of the markets based on lack of supply. So if you bought in one of those markets where a lot of people are moving to, I always say, real estate exists for people. So if there's no people, it's harder. If there's a lot of people, then rents go up, so it's just a supply and demand issue on every single thing: commercial, industrial, retail, office, and homes or apartments or whatever. So if your market has high growth for employment and population, let's say, then you're probably going to be okay because the market's going to save you. And so that, for me, has to be one of the factors. So if some of these people that bought thin deals, let's say, and they're in transitional markets for whatever reason, and they're not necessarily getting their their capital costs on their renovations are a lot more than they thought they would be, because I would guess that's most people here, because of what's happening on the labor and the materials, because we're as I said, we're building 6 projects, so and we're renovating $28 million right now in our renovation company for all the stuff that we have. So So we're being impacted too, but things that we thought we're going to, do at 7 or 8 or 9, 10,000 unit or a lot more than that. So all that stuff factors into the thinness. And then of course the exit cap rate, based on whatever that is. So if you have a deal that you have to get out of because your equity partner says you have to be out by 1 or 2 or 3 years from now, you should probably be taking note if you're running out of your reserves and you're barely keeping up, or you can't manage your renovations well, or you hate your property manager, or the occupancy is not good, or the rent growth isn't there, or whatever.
Right.
So all of those things, so it's obviously situational, but I do think thin deals in marginal markets, and luckily there's not a lot of marginal markets in multifamily, but
Right.
that's a good thing.
Yeah, and the flip side of that too is you have so many people that are, at least the feedback I'm getting from all of our clients is there's a little bit of overbidding out there, right? So people are kind of going crazy.
A little.
If Ben Franklin, if he's on, I'd love you to meet, because you had a great question that I know it's not necessarily on every, I get it in the form of a complaint, not necessarily a question, but the way you framed it, Ben, was great. And if you're on, I think you are, I see you there. If you want to go ahead and ask it, because I thought it was great, and I think it'll bring a lot of value to the rest of the community. Ben, are you on?
Yeah, hi Mauricio, thank you.
Hey, Ben.
Hey, Ken, great to meet you. Thank you for this. The question I posted was, I'm still bullish long term, and I'm sure pretty much everyone here is bullish, even with the recent price rises and the long term for apartment buildings. And some people, as prices have gone up so quickly in the last few years, refer to it as a bubble. I don't think it is. I think the fundamentals are there. The interest rates were low. But it feels like where there may be a bubble is in the syndication world, because there's so many mentors, there's so many groups now, and probably thousands of people have come into this world over the last couple of years, many of which have never run a business, have never acted as a fiduciary, and don't really understand risk reward. And I say that coming from a finance background. So when I'm trying to compete and win deals, I feel like I'm competing with people that will overbid, perhaps unknowingly, and honestly, perhaps knowingly as well, even when they're dealing with other people's money. So I wondered if you had any thoughts about how best to compete in a market when you're competing with people that are bidding in that manner.
Yeah, it's a great question. So I'll speak to you from personal experience. First of all, I don't believe that apartments are in a bubble. I think we're severely undersupplied, and there's not a lot of new construction, and rents are going to go up as a result of that. If you just look at the last 10 years, we've severely undersupplied the United States for housing, both condos, apartments, residential, you name it. So I think it's somewhere right around 5 million short. So we already have that issue, and there's a whole number of reasons for that, but we won't go into that here. So I don't think that we're in a bubble. I think it's a lack of supply that's primarily the issue. And to address your issue or your concern directly, so I am, we're in the middle of best and finals every week, so like on the deals that we, like the Austin deal I got, that I think there were 52 bids, and 3 or 4 rounds of best and finals, and then you get to that point. I can tell you that if you're working with a good brokerage company, they're not even dealing with people that are syndicating. So they're basically dealing with groups that have big funds or committed capital already. So, and I'm not saying, that's how competitive it is. So the sellers are now really asking really deep questions and thorough questions around the equity and the capital. And so I'm sure a lot of you have to come to those meetings and those best and finals very prepared. So if you're in a group of 5 people and one's represented by Goldman, one's represented by Blackstone, one's represented by Colony Capital, one's represented by Franklin or whoever. And then I have a list of people that that are investing with me. That's considered. And so if you're way above, or they're probably going to pass. That's been my experience. In other words, the sellers are looking for more of the certainty because of the competition. So in other words, because it's so competitive, the sellers and the brokers have a lot of choices, and the syndicated money is actually a very weak position at that level. And so it could be possible that some of these syndication newbies are overbidding, but it's not happening in my arena, at least. But it's very possibly happening in some of the smaller price stuff, which I haven't done in a while. So we're really not bidding on anything under 50 million. So but in that lower space, it very well could be happening. But we're not seeing a lot of deals fall out. And I think so I think what's happened is even guys that started off syndicating are now partnering with bigger groups, and so that's a much more aligned scenario. And it's not necessarily good for the syndicator because the equity is a lot more expensive, and it comes with a lot of teeth. But that is kind of how we're having to get deals these days, and that's part of the reason why I started a fund. Is we've been syndicating for 20 years very successfully, and a couple of years ago we started losing out to deals that guys had partnered with these big groups, and talk pretty candidly with the with the brokers and the sellers. It's basically a certainty of close issue. If somebody can prove that they have 100 million in the bank, or they have 100 million or 200 million in a fund committed, that check the box on the equity is over. If you have to say, oh, I have a big list of people, it's a risk. So hopefully that makes sense.
Yeah, it makes. I'm glad you brought the fund, because I think that's one of the reasons so many people are starting to do funds, is because you do have the capital in the bank, and you don't have to compete with that. But it actually is a great transition for another question that was submitted with Drew, because I don't want to say none of the folks on the call, but most folks on the call are not at the level of doing 50, 60, $100 million deals right now. And so, Drew, if you're on, I'd love for you to ask your question, because I know a lot of times, Kenny, we talk, and we've talked about it before, like you start with your story of how you started. Look, you started from nothing, 2-bedroom, 2-bath condo. That's how you started. But Drew had a great question of getting you back in that time frame when you were kind of starting with the syndication. See if you can get back in that world. Drew, are you around? If not, I'll read the question. But if Drew's there, I'd love.
Yeah, I'm on.
Awesome, Drew, man. Why don't you? I know yours had like a multiple parts, but I really think this brings a lot of value, and it'll be challenging for Ken to go back 20 years or however it was for those first few deals, Ken, that you syndicated. But I thought Drew's question was very interesting. Drew, go ahead.
Yeah. So, well, great to meet you, Ken, virtually. So my question was more about, obviously in today's world, today, your name, you can raise 60 million, I think, in a couple of days. I heard you say one time. But what about in the early multifamily days, say when raising 2 million may have been a challenge? What was that like for you? What were the obstacles you ran into? How did you solve them? Just those kinds of questions around like that period of time in your career.
Yeah, good question. So thanks for bringing me back there too, because I do like to talk about it. So I started in property management, and and there's a reason why I'm going here. So I was managing properties in college and to pay rent and going to school, and so my first job was right out, was actually running an apartment building, collecting rent. I grew up in construction, so doing all that, cleaning units, painting units, all that stuff. So what happened for me was my first job when I actually worked in property management. And so for the first 7 years, that's all I did, fee management. And that was my first job out of school. But the reason I did it is because the guy I went to work for was the biggest in Seattle. He had a construction company, he had a brokerage company, and he was a multifamily guy. And his name was John Goodman. And his company, I think it's called Goodman Management today. It was Pinnacle, if it's called Pinnacle. So I was one of the original guys there. Anyway, the reason why I bring that up first is because when I made the transition, Drew, to raise money, I had actually already kind of been in the game on the other side of it. So I'd been sitting with the lenders and the syndicators, and and I was in the property management world, and we were paying their bills, and I understood the cash flows, and also in property management, you usually get handed problems, problem projects, and if you get an account, it's because they fired someone, or you have an existing relationship with a client. So, and in the property management world, if you don't increase the NOI, you get fired. So what happens is I had all these skills that I was working on how to grow revenue, how to save on expenses, how to manage debt, and how to manage insurance issues, and all those kinds of stuff I had learned, which is huge. So when I got to raise capital for the first time, I actually saw value adds all day long because I was doing it. I was doing it as a property manager. So when I actually started raising money, and I do this today, so before I close on anything, I really know, like, okay, this is proved out here, here. And I know that I'm going to be able to grow my NOI on this. I don't do a pie in the sky. I don't say rent growth is going to be 5 to 10% and all this shit, no flat expenses, and we're better than the next guy or anything like that. I've just been around it enough to know. So what happened is because of that background, now I'm sitting with guys that I'm raising equity on, and I'm going, here's where we are today. Here's what I'm going to do year 1, year 2, year 3. And so, I was super calculated and strategic around all of it. And so oddly enough, it was not that hard to raise capital. I wasn't in any of the circles, but it was hard for me to identify the deal. And the bigger issue was, who are you, and why would I, how are you going to put this in escrow, and how where are you going to come up with the deposits and all that kind of stuff, and put the team together. So for me, it was all of that. But I very much understood the difference between, where I could take it or where I couldn't, and when I couldn't. I passed on a lot of deals based on my operations experience, and that's actually kind of the secret sauce we still have today. I don't buy anything based on where the market's heading at all. I use the word the real estate guys use, forced equity. And so for me, every single deal we have has to have forced equity. And if you package that right to anyone, you'd be super surprised how you're like, oh yeah, that, because it's math. So, and how simple that can be. I was not in any circles at all. My parents, they didn't go to college. I didn't, I wasn't involved. I didn't know where money was or anything like that. So I just started, I went to my rich uncle, and he said no very politely. And it was a process of no's. And then eventually, if the deal's good, as we like to say, it's the bigger the brochure, the worse the deal. So, if you can do it on a napkin really quick, like today, boom, 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 with the right amount of people, especially with the internet. You remember when I started, I didn't have that, and now you can put shit on LinkedIn and, different places, and, it's like, it's like everybody's reaching out all the time. So it was a lot harder then, but hopefully that answers your question.
Yeah,
It does. Great. I appreciate it.
Thanks, Ken. Hey, I'm going to open it up. I know there's a bunch of stuff going on in the chat. I know, Bethany, you've been monitoring that. You want to bring somebody up
Yeah,
in the few
I
minutes
have.
remaining here?
VK has a question. V, are you still on? You want to ask your question? You can unmute yourself. V, no, maybe not. So V asked, if you have a ground up construction project, but you haven't started yet, would you start now? And the market is the Austin MSA.
That's a loaded question, but I love it.
It is.
So this is interesting. So Ross and I, my partner, we own 6 pieces of dirt. We are the general contractor, and I have a deal signed with the Carlisle Group to do all of my construction. So I have the land, I have I'm the general, and I have the equity and the debt. And we are seriously considering not building because we have 2 under construction now. We have 4 others in pre-development. We are not sure whether or not we're going to be able to deliver the project at the cost that we think based on today. So none of the subcontractors are really committed and can really give you certainty on their labor costs and their material costs, and times 100. So you're not going to get a GMP or a gross maximum price from a general that's going to actually this is why home builders, when you're buying a home today and you buy a lot, they're not going to commit the price to you. It's going to be whatever it is with their margin. So we, Ross and I are sitting there going, man, like we're afraid of performance on our own projects. So now, that could change, but we're concerned about the supply chain issues. Now this interest rate issue is going to also hurt, a lot of those suppliers and those companies and those general contractors and the subs. So I'm very concerned about the cost of construction. I do think even on the 2 that we have going, we're more than making it up in rent growth, but that's no way to do it. Honestly, we're lucky, but I don't like that being the way that the deal works, is that the market helped me on rent. We're way over on construction, and we're having a tough time. We're building a property that's in Tucson, right next to Amazon. So actually, we started first. Amazon is building. They're getting a lot of concrete. We're not getting any. So, we're just a small, well, big for Arizona, but, not compared to somebody who's building an Amazon. So, fulfillment center. So, there's shortages, there's stuff being allocated. So I'm very concerned about the cost of construction and whether or not it's gonna, because what happens with construction is you have a personal guarantee on the construction loan. So you have, let's say the cost of the deal is 60 million. So let's say it's 40 million of debt and 20 million of equity. But if the deal costs 70 million or 65 million, that's where our head is okay. What's going to happen here? You have to finish the project. And that money's got to come from somewhere. It's either going to be a dilution of the partnership. It's going to be an equity, more equity. That's going to be something. So, so that's what I'm thinking about. It's hard to know about your Austin deal because, that's a very specific project, but that's what's going on in my brain.
Yeah, that's great stuff. Yeah, very specific stuff too. Bethany, a couple more here before we let Mr. McElroy go.
Absolutely. Drew Niflin has a question after his insights about Warren Buffett. Drew, are you on?
Drew's in the house.
No. All right. Well,
let's read it. I think it's a good question.
Yeah, I can just read it.
Go ahead.
It's a good question. So he's asking, what is the most critical skill to be a superior operator to the competition?
And Kenny, before you let's go to the preview too, because he talked about Buffett. Buffett is famous for saying, when the tide goes out, you find out who has been swimming naked, right? So in this market of rising interest rates, we're going to see who truly has the operational capabilities to stand out from the rest. And so that's the question of what the critical skill. But I think you talked a little bit about it already, right? The property management, that's always been your sort of superpower, right?
Yeah, there's a few things though that you can do here. From an operation standpoint, when COVID hit, as an example, we decided that we were going to have 6 months reserves of interest rate of our payment, as an example. So, we didn't know who's going to pay in April or May. So, it's because we do everything in house. We now have 6 months of interest, mortgage payments in the bank on every single deal that we have. So we have reserves all over the place now. So, what gets you through downtimes are reserves. What doesn't get you through downtime is, when you're distributing money and you don't have adequate reserves and you need them for something. It doesn't really matter what. That could be maybe you're on interest only and you have now interest, principal and interest payment. Maybe your payment went up. It could be you have a big loss for some reason. It could be whatever it is, something that's unforeseen. And so that's what gets people in trouble, is if they're thin already, they don't have cash reserves. Because if you have cash reserves, you can make some plans. There are things that you can do and manage these through some of these tough periods. And I will tell you one thing, from having been through this business a while, the banks don't want their projects back. I mean that, they just do not. So the best thing you can do is go sit down with them and try to figure this out and work with them and get a 1-year extension, and you'll get educated during that period of time. But we've had to do stuff like that on things that lagged, and markets had changed, and we've never had a cash call and we've never had a default, but we've had problems. And so I think that that's when that's when the blind spots show up.
Ken, do you usually hold 6 months reserves? Is that your sort of your baseline, or was that something that you then decided once COVID hit that you were going to increase your reserves to 6 months?
Yeah, that's what we decided to do. Obviously nobody knew the pandemic was going to start, and the government was going to say, hey, you don't have to pay rent. That's probably as bad as it could get, I would guess. But regardless, we decided that, we wanted a fair amount of reserves on each project. And by the way, it could be for anything, right? It could be, but it just, instead of distributing your money and maybe you just have a plan to build up some reserves so that you have adequate capital on hand. It's still the investor's money, but you're just holding it to preserve the asset for anything that might come.
What do you, Kenny, if you don't mind me asking, what do you usually underwrite for reserves? What do you usually on normal times you keep? 3 months, 4 months, 2 months? What's the normal?
Yeah. So we have a bunch of categories for reserves. So I have an insurance reserve, a tax reserve, a renovation replacement reserve, so CapEx reserve. And then if we buy something that's maybe a big value add, we would have another reserve for that. And for the mortgages, I know this sounds like a lot of reserves, but this is from getting the hell kicked out of us over the years. We had I think 2 months in reserves, and then we bumped it to 6 after a lot of internal debate. Again, we just tell the investors, say, hey, listen, I mean, in some cases, think about it. We have mortgage payments that are $100,000 a month. We'll have 600,000 in cash sitting in the bank, but it belongs to the LLC. If we sell the LLC, it gets distributed. So it's their money, but it's just prudent to manage these things with lots of reserves going into, these times.
Yeah, no, that's good stuff. Thank you for that. Let's get one more in and squeeze one more in before we let Ken go. Is there a really good one in there, Bethany?
Yeah, I think so. And George has had his hand up. So George, and you typed it in here. You want to ask it or you want me to read it? All right, I'll read
Okay,
it.
can I ask?
Yeah, yeah.
Okay, I'm very new. I just started, and I'm actually doing training actually right now. So I'm just getting down with my underwriting, so learning how to be a better underwriter. But before I really get into this, I'm listening to what's being said, and would it be better to start smaller? I mean, I want to start small anyway, but something like duplexes, something like that, build up cash reserves, or just go straight into multifamily commercial as a syndicator in this market, or which would be better, I would think, or is it a good idea to kind of try to do both?
Yeah. So the way I look at everything is, not a kind of, A or B or black and white. I even me, I'm all over the place. I love real estate. I think that if you can find a great duplex that, like on a house hack situation, where you live in one side and the renter pays for the other, I think that's a great way to start. Why wouldn't you have a tenant pay for your own, living? And then, if it comes with an acre piece of land, and you can build 4 more units, then I would do that. And then at the same time, maybe I throw 100 grand into something else. And so for me, it all has to do with the deal itself and the math. And so the way I've done it is I've had a series of all kinds of stuff. So I bought billboards. I still own a couple. I've done a lot of ground development, land development. I've done duplexes, fourplexes, condo projects, condo conversions, office, self-storage. And so for me, I'm just always I'm just kind of a deal guy, and I always stay grounded to the math itself. So if the math works, then I usually move forward on it. So like I hadn't done any office buildings before, but the math worked. We bought it, and the rents were, basically half of what they are today. I still own it. We're listing it actually next month. And we bought it for 3 and we're listing it for 10.5. And I put about $1 million into it. So I think so we have about, call it $6 million of equity we created by just, this is a value add, just turning the tenants over. Now we're trending close to $30 a foot on this building. And we started in somewhere around the 13, 14, 15 range or something. And so I just look at every single thing that way. And like on the billboards, as Mauricio knows, billboards they have no tenants. So it's the greatest business ever. You basically got a pole with, with 2 ads on each side, and those ads can produce 50, 60,000 a year, at 3,000 or 4,000 a month on, and so,
Ferrari payment, Ken.
Yeah. The billboards, the billboards themselves were, I think we paid like 250, 400,000 each or something. And so I'm just looking for cash flow. I'm looking for passive income. And, and so I'm kind of known for the multifamily stuff, but we're kind of spread all over the place. And I'm investing in some of my friends' syndications too. I've helped people start up their own syndications that were investors with me, and I've invested with them. So is my partner Ross. And so I just say yes to everything as long as it works financially.
Great answer. Kenny, I know you got to go, man. I really, on behalf of the entire community, man, thanks so much for taking time out of your extremely busy schedule. Really appreciate it. Everybody give him a virtual hand there.
Thank you, guys.
I'm going to stick around, but Ken, thanks so much, buddy. I'll see you soon, and really appreciate your time.
100%. Nice to meet you. Nice shirt, by the way.
Thank you. Somebody was asking me about it.
Thank you,
Thanks,
Ken.
Kenny.
See you guys.
I'm going to stick around. I'm going to stick around to answer questions, but I won't be offended if you came to listen to Kenny. But I'll give everybody a few minutes here. But as always, after this, I'd like to open it up to AMA. And if Bethany and I have any insights for any legal questions, please feel free to drop them in there, and we can get going. And we'll do this for a little longer, and then everybody else enjoy the rest of their Wednesday. Anything popping up there yet?
Yeah, I mean, they're for Ken.
I know.
Mostly. I'm not sure if you want us to weigh in on the market, right?
No, I'm not. They don't care about what I.
No one cares what we think about that.
Although I do think it was interesting, and I was going to bring it up, and then he brought it up, which is one of the reasons we've talked about this, in prior episodes, where it's the explosion of funds, and that's one of the reasons people are doing funds, is because you can, you obviously raise the money first, you've got it in their bank account, and it does put you in a much stronger position. Look, I get it. Kenny's doing, $60 million, $100 million deals, but even if you're doing a $5 million or let's say you're doing a $10 million deal and you need $3 million in equity, if you've got that $3 million in the bank already, that'll knock off all the other syndicators who still have to raise. And I think I think it was Ben's question that, how do you compete with those guys? Well, as Ken mentioned, the feedback we're getting is that the sellers want certainty, especially in this market, because who knows what's going to happen with cap rates. And so they'd much rather have somebody that can close. And so if you show up to the table with, $3 million that you could show in the bank, you're going to be in a much stronger position than if you have to go raise the capital. So.
Right. Yeah. And I know,
sorry, Bethany, I muted you because it was a lot. Let me unmute you. Sorry.
Sorry.
That was me.
One of the things that the panel mentioned last Thursday was about how, and I think Ken mentioned it just a minute ago, was how many syndicators are popping up, right? And so there's a ton in the market, and one of the things that'll set people apart is being able to raise a fund, which means having a track record. So the people that have been doing deals and been doing a good job for people and who have not been swimming naked, as the Warren Buffett quote was, I think they're going to be fine because they can raise a fund and they can sideline the money if they need to, and then be flexible when it's time.
Yep. I know somebody commented, one of my favorite Kenny quotes is always, the bigger the brochure, the crappier the deal, which is one of his favorite quotes.
Which I really appreciate, being the one that has to go through the brochures to do all the compliance.
But it's a little bit tough because Kenny's obviously doing huge deals, and so it's sometimes challenging to bring it back to the early days. But all right, any questions or hey man, free legal advice? No, that shouldn't say that. I should start doing my disclaimers that this is not legal advice. This is entertainment purposes only.
That's right. Even though we're lawyers and don't know how to turn it off.
Cornelius keeps asking about the demo, buddy. I don't know. I'm not a demo day guy, so that's not the area that I really practice in. So I know it does have to do with whether it's considered advertising or not, and there's some exemptions with demo days and what you can and cannot say. But that's really mostly it's not really done in real estate. A lot of it is done for products. When you're raising capital for a particular product, people go on a road show and they go do all that stuff. But a couple of hands are up. I don't know if those are questions for us, or are they new questions, or
they're new questions.
All right, good.
I know Taylor. I talked to you about Taylor. Taylor's the Bitcoin mining guy. Hey, Taylor, unmute yourself and ask your question.
Hi. Yeah, that is. I mean, kind of related. What are you seeing regarding tokenization of securities and funds?
I am extremely fascinated with it. I believe tokenization of pretty much everything will be the norm here pretty soon. Tokenization of real estate for sure, but we're already getting calls, and I'm working with another firm right now for people wanting to tokenize their syndications. And so the idea is that instead of, and by the way, it's not really crazy when you think about it. All it is you're doing a syndication, and instead of giving people, or when you give people shares in the company or membership units in the LLC, that representation of those memberships can get tokenized and turned into, whether you want to call it just a token, an NFT, whatever you want to call it, but that gets represented digitally, that gets put on the blockchain. So there's no dispute, obviously, as who's to own it. And the idea, or the really exciting thing about that, is that you can then put those tokens after a year goes by, you can put those tokens on some kind of a marketplace or something. So you can actually start getting some liquidity, secondary market liquidity, which is one of the big downsides of syndications right now. If you're an investor and I put $100,000 into your deal and yours is a 5 to 7 year play, I'm quote unquote stuck, or I'm in your deal for the next 5 or 7 years. It's very difficult for me to go, not impossible, but difficult to go sell my, 3% interest in the syndication to somebody else. But the idea being that if you were able to tokenize that, which we can, then that is something that I can put on an exchange or freely trade it once it becomes a tradable security. And I have the option of, maybe I've got a 3% ownership. So I've got, 3 tokens or 30 tokens, and I can sell 1 or 2, or I can, sell this or trade it somewhere else. So it gives that secondary liquidity. But the most important thing I would say, and this is probably not news to you, Taylor, but these are all securities, right? So nothing changes from a security standpoint. In fact, step 1, the way we've been doing these currently, is step 1 is virtually no different structurally. So it's still a syndication. It's still an LLC. Everybody puts in cash. We're not receiving Bitcoin or Ether or anything. We're receiving cash, and then we're issuing membership certificates. And then what happens is, because if you guys remember, when you're doing a 506B or a 506C, you actually have what we call restricted securities. You can't invest $100,000 in my deal and then the next day go sell it somewhere else. You have a 1-year holding period. And so that 1-year holding period rings true even if you tokenize it. So most people will invest in the syndication, and then a little bit before a year, but let's say 9 months down the road, we'll start the process of minting the tokens and creating those tokens so that we have that representation in the future so that they can then trade with that. There's a lot of issues that you've got to come through, which is I'm kind of working my way through. I mean, who are you going to give your K1s if people put their tokens and they put it on some exchange and they start trading it? Well, you've got a responsibility to know who the members of the LLC are. And so they're usually some kind of a representative, almost like an intermediary that keeps track of all that stuff. So there's a lot of issues with it, but we're already getting, I don't know, Bethany, how many we get. We probably get 2 or 3 calls every month about, if not doing a tokenization, asking me about tokenization. And I do believe that 5 years from now, when we're on Real Estate Syndicator Live episode, 150 or 200, I think more syndications, the majority of the syndications will be tokenizations versus not tokenization. And 10 years from now, all the syndications will be tokenized. And I think we're going to be seeing the tokenization of everything. I think your concert tickets will be tokenized and be on the broker thing. I think your marriage license, your DMV certificates, your, certainly title, the title be on the blockchain. There's going to be no need for title companies anymore, because, why the whole point of a title company, you can just have that on the blockchain. There's no reason to have some title insurance. I think those title insurance folks are on their way out, and there's just 1,000 or 1,000,000 things to do. But I do think it's coming, and that's why we're kind of positioning ourselves to be at the forefront of that, because it's something that it's just a wave that I can just see it's coming.
Yeah, in a few months.
Go ahead.
I was saying, in a few months, I think we're going to have to dedicate a live just to this.
Oh, for sure. Yeah. I mean, I'm actually working on an ebook. I think I'm just going to call it sort of the real estate tokenization 101. Nothing super fancy, but when that comes out, we'll definitely do a live on that. And so Taylor, hopefully you can join us for that.
Yeah, I would love to. And of course, I agree completely. That the future is, everything's going to be tokenized on the blockchain. But I did have one kind of more legal related question. What's the difference between a syndication and a fund?
Great question. And the answer is none. Let me put it this way. Let me make sure I say this correctly. All funds are syndications. Not all syndications are funds, right? But a fund, meaning you're pooling capital. The only difference between a fund and a project specific, which is what most people think of a syndication. When most people think of a syndication, you're raising capital for a specific property or maybe a portfolio of property. That's what a syndication is. A fund is just, instead of finding the property first and then raising the money, a fund is you raise the money first and then you go look for the property. So just reversing the thing. But either way, it's a security. It's the exact same rules. It's 506B, 506E, Reg A, whatever exemption you need, and you're going to follow those to the T. The main difference, and structurally, is going to look very similar. It's still an LLC. It's still an operating agreement. It's still Class A, Class B. It's still 8%, whatever the structure is. The main difference is going to be your business plan, because your business plan, unlike a project-specific, syndication, where you have pretty pictures of the property and information about the marketplace and information about, whatever, all specifics, you don't know what the property looks like. So it's going to be very generalized, fund criteria is what we call it, or parameters, where we say, look, I'm raising money to go buy multifamily in the 50 to 100 unit range in the Oklahoma, Texas, whatever area, or however you want to define it. Some people get really broad because you can get away with that. I always bring up, we do all the stuff for Brandon Turner, the Bigger Pockets guys. And because of the reach that they have, they basically just say, hey, we're raising money to go buy mobile home parks in the United States, period. Right? Most of us can't get away with it. Kenny could probably get away with that. Hey, I'm raising money to go buy multifamily, B-class multifamily in the United States. Most of us have to put some more parameters of what's the leverage, what's the location, what's the, are these value adds, or these whatever, but you want to try and give us the least amount of, you don't want to be tied up. So you give the least amount of parameters you can get away with, but you've got to have to give them parameters so that you can convince investors to actually, invest money with you. But that's the main difference. It's just you're raising the capital first, and then you're looking for the property as opposed to the other way around. But both of them are securities.
Thank you.
Good. We have to get to Kara Kennedy. I saw your note in there, Kara. So I am a Bowling Green graduate. Yay, some Midwest. You're just across the way. Go ahead, ask your question.
Cool. Hey, Kara, how are you? How's my
well,
off-roading buddy?
Yeah, I'm doing great. Nice to see you again. Thanks for extending the invite here.
Yeah.
I'm looking at my first deal of joining a syndication for small business, a small business raise, I suppose. They're purchasing retail medical facilities and businesses and, doing a value add push with them there. Is there anything different I should look out for during my due diligence as just a private investor?
You being you're passively investing in that deal. Yeah. So So probably, the nice thing about a passive investor is obviously you're passive, but the work that you do is on the front end. So the idea of being passive is you put in all the work ahead of time, then you write a check, and then it's passive. And so there's several things you want to look for. I think we always start with the team. You want to make sure you're doing your due diligence on the team or the sponsor. When I see this being sponsors, like have they, what's their track record? Have they syndicated before? Have they invested in real estate? Have they invested specifically in this medical retail? Because I think we talked about that with Kenny in some other video where Kenny's a multifamily guy. He's not a mobile home park investor, right? So even Kenny, he would have to partner with somebody. So somebody on the team needs to have that expertise in that particular asset class. So in your case, if it's medical retail, who's the expert there? What kind of expertise do they have? Do they have a team? What's their communication process? You want to do a deep dive into them. If you can somehow get, not necessarily referrals, because I think a referral, they're just going to send you their best investors. If there's a way for you to find out other people who have invested with them and get a hold of them and ask them, how were they responsibly, were they any good? So that's one thing. Obviously, you want to do the due diligence on the specific property itself and the market it's in, because, you're not going to go fly down there and do a tour unless it's in your backyard, but you definitely want to do your due diligence on the team, on the property, and then just make sure that the values are there. Like what's your personal investment philosophy? Because if you're a cash flow investor and you're looking for cash flow, and this is a deal they're not going to give you cash flow for 3 years because they're doing, all this other stuff, and that's different. Or maybe it's the other way around. Maybe you're looking for high growth equity, but this is a cash flow play and there's really not much upside. So just making sure the investment philosophies are aligned. I think that's another important thing. And then once you're comfortable, the nice thing about that is you can put all the work, and then if you're comfortable with that sponsor and you invest, then you don't have to go do the due diligence again if they have another deal, because you can do that. But to me, it's all about the sponsor. Anybody can put together a pretty brochure, as Kenny mentioned, the bigger the brochure, the crappier the deal, but can they execute on that business plan? Do they have the team, the expertise, the knowledge to actually pull off whatever's in the pretty pictures?
Awesome. Thank you.
Yeah, of course. Thank you. I saw a question from Brian, which I love because I don't talk about this much. So I'm going to just jump in here and ask it. But so Brian asks, have you ever done a deal using Rule 504 instead of a Rule 50? It says A and B, but B and C. And I get this question every so often, but there's a reason why you don't hear me, Bethany, or any securities lawyer talking about Rule 504. And because the nice thing about on its surface, you look at Rule 504, it actually allows you to take non-accredited investors and not have to do sort of a full-blown PPM, right? So it's actually, there's actually a lot of great things about it if you just look at Rule 504. But I'll go back to something I always say. The reason 506B and 506C are the most popular exemptions, there's always two things I talk about. One is that it preempts state law. I don't have to worry about the states. And number two, they're safe harbors, right? The problem with Rule 504 is it does not preempt state law. So even though I may comply with the rule at the federal level, if I've got investors from 7 different states, I have to make sure I go to those 7 states, hire an attorney for those 7 states, and make sure that my syndication is compliant with every single corporate security statute in those states. There's no preemption. And so unless you're doing a really small deal where, you know, everybody's in the same state, maybe, although then there's another exemption we can rely on, which is the intrastate exemption, which is similar problem. It's great, except, you know, I've got to worry about the particular state. But if it's one state, maybe that makes sense. So if I'm raising money here in California, exclusively in California, maybe I can go with, and it depends on the states. Like I've had deals where, like I remember the state of Pennsylvania, for example, it's always, they don't have much. I mean, they kind of self-execute exemptions. I remember doing it really inexpensively, it wasn't a 504, but it was an intrastate exemption because everybody was inside the state of Pennsylvania, the sponsor, the LLC, the investors, there was no marketing. So we did that and it was cheap. But I try to do the same thing in Florida, and the Florida lawyers, like, it's so complicated, we end up doing 506Bs. So that's why you don't hear us talk about 504, is because even though you may look like you're complying Rule 504, you've got to now look how many different states do you have investors, and you have to go make sure that you're complying in all those things. That's the main reason we don't talk about it. But great question. Jeff's got his hand up there. Jeff, you want to unmute?
Yeah, can you hear me?
I can hear you. You're not going to ask me about the 40 Act, are you?
No. I just got back from a fund conference in Vegas, and about 40% of the people were real estate, and about half, I would say, were crypto and blockchain. And we got bombarded with talking about tokenization of real estate. And it pretty much convinced me that that's how I want to do it. So I'll have to follow back up with you.
Yeah.
So one of the things they talked about from the sales training is there's a book out there. They talk about blue ocean, red ocean. I don't know if you're familiar with that concept.
No.
So red ocean is basically the same old, tried and true. Everybody knows about it. Vanilla, it's like a commodity. And then blue ocean is like something brand new. And when you break out in a blue ocean, there's so much upside. So what they talk about is you want to do a blend. You want to find something that's blue ocean principle that you can sell to a red ocean crowd. So when you're out there talking to investors and you're saying, you know, I'm doing to get them to get on and get in the room with you and talk to you, you want something like, well, we're doing something different. And then but in order for them to invest with you, you got to dive into something that's plain vanilla that they're familiar with. It's a PPM. They feel comfortable with it, and so, you know. But you hook them by that blue ocean concept of, here's what we're doing. We're tokenizing the real estate. So hopefully there's a secondary market. It's creating more liquidity for real estate that just wasn't there in the past.
That's a great. And I've heard of the blue ocean strategy. I hadn't heard about the blue ocean, red ocean, but that's exactly what the tokenization is. Everybody understands. Well, people know what real estate looks like. They know what a PPM looks like. So it's the same vanilla thing from that perspective, but you've got this little additional, like you said, this unique thing, which is like, hey, in 8 months or so, we're going to tokenize you, because you could theoretically mint them right off the bat and do almost like an initial coin offering, but that's not the way most of us are doing it. But, you know, the first 9 months is going to look almost identical to your red ocean. Yes, we're going to have risk factors and let them know that we're going to be tokenizing, but it's this world that you're sort of, you know, you're ahead of the game, but you're basically like, we're going to tokenize this. And then when that restriction is lifted in 1 year, because all of these have restricted securities for 1 year, you're going to have the option to, if you wanted to, go put it on one of these platforms and liquidate some or all, or trade, or do whatever you want. Now, right now, I would say the biggest challenge is that nobody, to my knowledge anyway, has come up with a marketplace or an exchange that really, that's going to be the key. Nobody's really done that yet, but that's coming. So just because it's not there now, so theoretically you could have a bazillion tokens right now, and theoretically you can trade them and put them on platforms, but I don't think you're going to, maybe you can go on like OpenSea or whatever, but realistically, somebody's going to have to create a marketplace, the real estate exchange, crypto exchange, or not really, crypto's not going to be the right word. It's going to be the real estate tokenization, the token exchange, where you're going to be able to put your, 3% syndication for this price, and and you bought it for 100 grand, but you know what? Now you've done the value add and it's worth more. So now you're going to sell it for 130 or 150 or whatever the number is.
Yeah, I can tell you that's in the works. People were talking about it, and there was two speakers on stage. They're already doing it, and they're doing it with single family homes and Airbnb rentals, and they're doing it, and they're going to multifamily with it next. So it's already there. They're already doing it, and there's people that are very hot topic on it. And because, you know, to me, there's so many of those, you know, Bitcoin crypto funds, and I'm like, well, I'm not going to just buy it. But if you're in the back end and doing the blockchain,
right,
that's where the new stuff is. So that's
Yep.
the next, you know, what they were calling Web 3.0. That's going to happen. So real estate
Yeah.
2.0 and Web 3.0.
I know. Yeah, I think Web 3.0 is almost like the meta thing. Yeah, there's actually
The metaverse. Yeah. So there was tons of stuff on the metaverse. There was tons of stuff about you know, NFTs, tokenization, and you know, the whole Web 3.0 that's about ready to explode. And you take a plain old vanilla thing like real estate, and then you figure that out. So, you know, that's definitely, and I think he was right on. Well, and it was kind of funny that Ken said that he started a fund just because, again, be able to, instead of doing the syndications where you find the deal and then raise the money first. And now all of a sudden you're ahead of your competition because, you know, we talk about price is one thing, but what wins you the deal are the terms, not the price.
Certainty. Yep. The certainty to close. And again, Kenny's at that level where he is competing with the BlackRocks and the car, like, you know, most of us are not, but it gives us an advantage over if somebody else has to go raise 5-10 million and we have it in the bank. I'm going to do a quick plug here because in September, there's a blockchain real estate summit that my friend Michael Flight's going to be putting on in Austin, Texas on the 23rd and 24th, which I'll be speaking at. And I think Robert Helms is emceeing it. But so if anybody's got any interest in the topic, and obviously you, Jeff, I'd recommend checking the blockchain real estate summit in Austin, September 23rd, 24th. But yeah, to me, that's fascinating. I'm super pumped. Nobody in my space, meaning when I say my space, my contemporaries in the legal side, I don't see anybody really moving. And so I'm kind of excited to kind of, you know, take this to the next level because Bethany and I are both convinced that 5 years from now, this won't be some thing we're talking about. It's going to be here.
Thank you.
Thanks, Jeff. Appreciate it, Jeff. Good to see you. I'm glad you didn't ask me about the 40 Act. And I'm going to respond to you on the Facebook group. I just, it was today. So
I figured, thank you. Yeah.
So I know it's past 5:30. We've got a few questions. Do you want to have those questions put into the Facebook group to respond to the rest of them?
No, let's do two more. And then, yeah, you're right. I think so because we had the guest, let's just do two more. And then, yeah, moving forward, I think I'm going to try and keep these to a reasonable time frame. But yeah, let's do two more.
Okay. OT Mendez asks, would 504 be better for international investors?
That's a great question. No, for international investors, there's an exemption for that called Reg S, right? So Regulation S as in Sam will handle if it's purely offshore. If it's purely offshore, forget about 504. I would just do Reg S because then the US doesn't care about international investors. The challenge is most of us are doing a blend where we'll have some offshore, some onshore. And so what's the onshore one you're doing? I wouldn't do a 504 for everyone. I would just do a 506B or C for onshore and then a Reg S for offshore. So I still don't like 504, I guess is my answer. You're not going to convince me otherwise. And by the way, yeah, I'm glad you brought that up, Bethany. If there's any questions we don't get to, just put them in the Facebook group and I'll definitely answer those over there because I've got, you know, during the day, I've got all the time in the world.
And that's the real estate syndicator community on Facebook.
Yep.
All right. So the other question, BD Dwight says, what are the top 3 things you look for in a PPM regarding GP non-performing clauses? And I don't know if he was asking that of us or of Jeff when Jeff was talking.
Top 3 things we look for in the PPM for GP non-performing clauses. So yeah. I think what I would so maybe I don't know if this is the answer because I'm not completely clear on the question, but anything that has to do with the GP performance or non-performance, that's going to be in the management agreement. So the GPs, and remember we talk about GP LPs, but really we're talking managers and members because most of us do limited liability companies, LLCs. And so the GP, we always create some kind of it's usually an LLC that houses all the GPs. So if you've got 3 or 4 or 5 GPs, we're going to create a management company that houses all of them. And then all of the roles, responsibilities, penalties, non-performance clauses, everything like that would be in that management agreement. But you know, there's not anything specifically that I would look for. I mean, the main thing I would be concerned about, which is the one, let's talk about this because this does come up quite a bit, but it's not going to be in the, and this is the challenge, it's not going to be in the GP agreement, is when you have these little side agreements or wink wink agreements, and sometimes not so much wink wink agreements, where people are going to get paid to raise money, right? So that comes up every so often where somebody's like, hey, I'm bringing this GP in, not properly, but I'm going to bring this GP in because they can raise $1 million. And so, hey, great, you come in, I'm going to give you 20% of the deal because you're going to be bringing in $1 million. And then it turns out they couldn't bring in $1 million. They only brought in 100 grand or zero. And now there's a dispute because like, wait a minute, I was going to give you. And so the challenge is none of that is in writing because you can't do it based on performance. So that's challenge number one. And we have seen disputes over that. And because it's not in writing anywhere, because it can't be, because it's not a legal thing that people are doing, that has created some issues. And the challenge is once you have membership in an entity, whether it's the main LLC, which it would be a Class B membership, or the management, you can't kick somebody else out. Like once they're a member, you can kick somebody out from the management role if they're not doing a good job or they're not performing. You can remove them as the manager, but unless there's some triggering event in the docs, you know, once you're a member, you know, just because if I own stock in Apple, you can't just take those stocks away from me because I didn't do some, unless there's some call option or something in the documents already that for non-performance of something, but we can't put non-performance of raising capital because that's not something that's, you know, allowed under the securities laws. You can't pay somebody to bring in capital. So there's no way you would put that in the documents, and there's no way you could allege non-performance of something that you shouldn't be agreeing to in the first place. So I don't know if that made sense enough, but that's kind of my answer there on that one.
Okay. And Francis had typed a question. I skipped over you, Francis. So thank you for raising your hand. I'll let you unmute and ask your question.
Hi, thank you so much. I appreciate it. So the question is, Mauricio, you were talking about vetting the team, which of course we've all heard a lot. And so I'm just getting into syndication. So how do I position myself as somebody, you know, if they want to vet me, I'm brand new, right? So then why would they trust me? You know, I know I'm trustworthy. You don't know I'm trustworthy, you know?
Yeah, we often recommend that if you're just starting out, like one of the things we see a lot is riding on the coattails of somebody that has experience, especially for their first couple of deals, right? Because you're right, unless you're going to do a smaller raise that you have, look, there's two ways to do it. If you're not going to do the coattails, one is it's a smaller raise, it's friends and family and people you really know, and they've already seen you perform and you've got a great track record. They're like, hey, I want to get in. I want to give you money, and I want to participate in what you're doing because real estate's hot or what have you. So that's one way to do it. The other way to do it is just you have a ginormous audience that you can just launch. You know, like you have zero experience, but you've got a huge podcast or a YouTube channel or something. You can literally just say one word and people will invest. But for the majority of us, what tends to happen, I know there's a bunch of them here. I've just seen them as they come in today, where you add value. I think Ashley Wilson had such a great quote. I think it was one of the lives where find something that you can, obviously you've been doing this, add value to a syndicator who has a lot of experience, who's been doing this all the time. And then even if, you're going to get a small sliver because it's the first one, 5%, 3%, I've seen ones with 2%, just so you can get your name out there so that when you do that 2 or 3 times, now you're ready to do your own by yourself. You can show them that track record, have done 3 deals, here are the 3 deals. And you I don't want to use the word usurp, but you piggyback off other people's experience. You talk about we, the team, right? So we did these 3 deals. My partners and I did this, my partners and I did that. And as long as you're able to add value, and Ashley talked about this brilliantly, which is like, come to the table with not what's in it for you, what can you get out of it, but what can I give to the syndicator? What do they need? Maybe, look, you're in Hawaii, right? So maybe they're interested in the Hawaii market. It'd be great to have somebody boots on the ground because it's a long flight from New York to Hawaii. And so having somebody boots on the ground, that's great. And so, hey, I'll give you 5% of the deal or 10% of the deal for being boots on the ground. Or, hey, you're a really good underwriter and I'll give you 2% so you can underwrite all these deals. Whatever it is that you can add value to the sponsor team, then you can piggyback off their experience. And I see this time and time again with the first 2 or 3 deals. You're one of 3 or 4 or 5 co-GPs, and then you're finally, hey, this is our first deal where I'm the lead sponsor and I'm doing, I'm taking the lead. That's probably the way I would do it.
Thank you.
Of course. Good to see you.
Yeah, you too.
The rest of the these chats are really just giving Francis some advice. Borrow the credibility of your of your partners. Rob
Good.
Rosell's a pro, so I would listen to Rob Rosell. He's got a ton of credibility.
Rob is the man.
Iris says they have their resume and their own background check that they provide, or get in as an LP on some deals.
And what I would do too, and I hate pitching things, but the Facebook community that we've got here, there's a ton of people that go in there, you ask your questions, and you get this. Look at everybody on the chat just giving you advice. Like, you just post it on the Facebook group. People are just such amazing, and they want to give their time, and they just give these amazing responses. So I'd highly recommend posting on the Facebook group, the Real Estate Syndicator community on Facebook. And then before I forget, I didn't want to do announcements, but next week, one of the other big topics that we haven't talked about yet is just this whole thing of joint ventures, right? Joint venture syndications. You know, how do you properly structure joint ventures to avoid securities violations or the securities law? So we're going to talk about that next week, next Wednesday at 4:30, same time. And then, as always, we'll stick around and answer any other questions you have if we don't have enough questions on the joint venture stuff. But
I put the link to the Facebook group in the chat, so if anybody
oh, perfect. Yeah, I saw
isn't already in there, you can go click on that.
Rob, it's called the Real Estate Syndicator community. And when I send out the replay on the emails, which you should all be getting, because if you're on this call, you're on that email, there's a link to the Facebook group in that replay email. But it is the Real Estate Syndicator community, and Bethany put a link to it in the chat, but that's where you get it, Rob. But yeah, thanks.
And make sure to answer the questions, because it takes longer to get back if we have to go figure out if you're interested in syndicating or not.
That'd be good. But anyway, I'll let everybody know. Thanks so much for joining us again. I hope you guys got some value with Kenny. I know I did, and looking forward to seeing you guys next week. Bye, everyone.
Bye.